we're going to be going over today how to scale your syndication business. So I'm going to keep the chat up here and the Q&A box. So be sure to put your questions in the chat or the Q&A. We'll get to those towards the end. But I wanted to go over kind of what we've done or what I feel are important steps to scale your syndication business. Obviously, we started PassiveInvesting.com. That's Dan Handford, Danny Randazzo, and myself as the founders and managing partners of PassiveInvesting.com. It's been, we started it in 2018. Obviously, we've been in real estate longer than that, but we started the actual formal company in 2018, and we've been able to scale at a very good rate. We've been very pleased with the rate of growth. We've hit our snags and our market turns and rate changes and all the rest of it, and we're able to continue a growth pattern that really I feel is unprecedented in the industry. And that is due largely in part to our wonderful team. But I want to talk a little bit today about how we get to that point and how we build such a wonderful team. So take some notes, sit back and sip on your coffee, and hopefully I can provide some value for you. That's the point of this. So one of the first things you want to do, and I'm just going to leave the screen up. I don't get real formal on my webinars. That's not my lane. I'm a very meat and potatoes kind of guy when it comes to this. My role in PassiveInvesting.com is in the acquisition side and also new line startup. So in the beginning, when we were doing multifamily only, my role was to find the property, so broker relations and building that pipeline. And then at the beginning, also I was doing in charge of all the renovations. So I was actually in the car and driving to sites with tools in the vehicle and actually, setting up suppliers and contractors and all the rest of it. And we quickly scaled away from that and have a team in place to handle all that. And then we also moved into different business lines. So we started Rehab Wallet, which is a hard money investing line. That's on the investor side or on the borrower side. And we also started the storage fund. PIC Storage Fund 1 was launched over a year ago and was closed out, and we were in PIC Storage 2. We've recently added a car wash, express car wash line of business and a hotel line of business. And so when we start those new lines of business, I'm involved at the beginning stage to kind of build that process out and build the pipeline again of deal flow and all the rest. And so I feel that I can help share a little bit of what I feel is important to scale your business, and hopefully you can apply it to what you're doing and grow at an even faster rate than we have. So determine your strengths and weaknesses is the first thing that I'm going to point out. The reason this is important is because you need to know where you need to add. And that's right off the bat, almost even before you start a business or start any kind of venture. You want to understand what your strengths are and what your weaknesses are. Your strengths are your strengths. There's things that you enjoy doing, things that you don't have to be told to do. You don't put them off. You don't procrastinate because you're passionate about them. Find out what those things are, and that's what you need to focus on, because those are the things you kind of get lost in. You're just working away. It's not really work to you. You enjoy it. Find out what that is and focus on those things, because that's what you're best at. In the book, Who Not How, they talk about procrastination and how it's a good thing because it helps identify the things that you should be handing off to other people. Those are your weaknesses. So in my case, we write articles for our newsletter, and it's something that I just don't feel I'm very good at. And so I find myself procrastinating on that one aspect. And so I've found people to assist with that. And we've also found a way to spread that out so it's not as consistently required of me, because that's not my strong suit. So we look for ways to offload the things that I'm not proficient at and focus on the things that I am proficient at. The other benefit to determining the strengths and weaknesses of yourself is because once you know your weakness, then you can identify what pieces you need to plug in. So if you're let's take PassiveInvesting.com, for instance. We have 3 partners that founded the company, and we each have our own specific roles. You'll hear us talk about this many times. It's crucial to our growth pattern, and we stay in those lanes because we understand our strengths. Dan Handford is very good at marketing, and he has successfully marketed and built businesses prior to PassiveInvesting.com. So he's very good on the business administration side and on the marketing side, so investor relations. And so he's very good at that. And that's what he enjoys doing. He really gets a thrill out of that. And so I don't enjoy that as much. And so that works out very well. I enjoy, construction and building and physical assets and touring the properties and talking with contractors and doing those sort of things. And so that is my lane. And and Danny enjoys the financial side of things, spreadsheets and financials and those types of things. And that's why it's his lane is capital markets, which is our debt, and also asset management. So he works with Brian Bornhorst, our asset manager, and works on that and budgeting and all the rest. So that's a very good example of how we have defined our roles based on what we're good at. And each of us does not really enjoy. We can do the other person's role, but it's not what we're best at. And so it works best if we stay out of each other's lanes and let them handle their own lane. And that has been key to our success. So identify what your weakness is. And then the next question that everybody has, or most people have, I should say, when asking about scale is, how do you find a good business partner? This is always something people are looking for, especially if you're doing it by yourself right now, you're doing the research and you want to grow, you're going to need a partner. That's a given. You cannot do it by yourself. The beautiful thing about having a partner is it provides perspective. There are many times when I have an idea or a thought that I think is a good idea, but I only have one perspective. And so we always make big decisions, all three of us together, Dan, Danny, and myself. We'll have meetings often and discuss ideas. And we'll each put our ideas out on the table, and we'll each put out our response to the other person's idea. And sometimes it's a rejection of one person's idea. Sometimes it's a change of one person's idea. Sometimes it's an acceptance of one person's idea. But we all are mutually in agreement at the end of that about how to move forward. And what that does is, as I said before, provide perspective, because there's some things that you just don't think about when you're only thinking about it from your one singular viewpoint. And so when I have a call with Danny and Dan will be like, well, what about this? You can't do that because this, this, and this. And I was like, I never thought about that. But what about now that you said that, but this creates this problem, what about this? And it's a back and forth, and it creates, it helps mitigate risk. It helps to make sure you don't have any blind spots. So it's very important to have a business partner if you want to scale partners, in my opinion. So to find that, I think it needs to be something very organic. Many people want to go out and just check the boxes. Okay, my business partner must have X, Y, Z. I'm going to look for that person, da, 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 da. And then that's how it's going to work. It's much more relational than that. You are in a friendship, partnership. You can even equate it to a marriage. We are very trusting of each other. This is something you have to get along with this person or people on a very personal level. When Dan, and myself started talking about getting this all going, we made it a point to even get together with the wives, and we still do so, to make sure everybody was clicking and there was no issues, no real glaring, personal issues, because you know how it is. Sometimes people just don't get along, and that's okay. But you want to be sure that it's very organic and it's very relational, and that you are able to focus on the personal side of things and not just on the business side of things. That will help grow a successful business and try to enjoy each other's company outside of business. Maybe do some enjoyable things. We go golfing or take some different trips together when able, to kind of keep that friendship healthy, if you will. But the best way to find business partners is through your network. So going to conferences or going to meetups and meeting people, and not with the intention of looking for something, but always looking for what you can provide, and not looking for what you can take. And once people understand that you're trying to help, then that opens up a conversation to how they can help you. It's the rule of reciprocity. And so once that occurs, you can start having conversations, and organically out of those conversations through networking, hopefully you'll be able to find a suitable business partner. I want to go ahead and pause for a second on that topic before I move to my next point and see if we have any questions. I'm going to go ahead and pull up my chat. I'm going to stop share for 1 second. Pull up the Q&A. All right, no questions so far. You guys are making it easy on me. All right, going on to the next topic is establishing your goals, teams, and systems. So now that you establish who your business partner is, or business partners are, then you want to together determine what your goals are. So for instance, are you going to be investing in mobile home parks, self-storage, car wash, hotel, multifamily? This is Multifamily Investor Nation. So obviously we're going to be talking about multifamily. So if you've determined that that's the route you're going to go, and that's the only business line, make sure everybody's in agreement with that, at least at this stage, because that was our only intention when we started PassiveInvesting.com, and it's grown into other things. But at that time, when we started, we were unified in multifamily. And then you're going to want to work on establishing your criteria, which is part of your goal. So what kind of assets in multifamily are you going to be looking for? And this is different than criteria for brokers. That's going to be a little more detailed, but well, equally detailed, I should say. But you want to go ahead and have a unified front with your partners at the beginning about what kind of assets you're going to go after. Are you going to go after value add? You're going to go after core deals, lease ups. Value add is, where you're actually doing brick and mortar renovations, drywall, countertops, renovating and making it better. Usually older vintage, 60s, 70s, 80s, not 60s, sorry, 70s, 80s, 90s vintage is usually going to be your value add deal. Or core is just a cash flowing deal. So you don't really need to do value add. It's in good shape. There's no deferred maintenance. It's cash flowing. So you just buy it and cash flow it. That's a core deal. Or the pre-stabilized lease up, which is a brand new deal. People the developer is trying to get it leased up and stabilized. And so they're offering concessions. Concessions get renewed on 12 months. So on lease renewals, the rents are increased to market rent, and that is your value add, if you will. Usually equal to a brick and mortar value add and the rent bumps that you can achieve. So you have to determine which route you want to go. And then determine what markets you want to start in. I recommend you start with a very specific criteria and a very specific location. Don't just say, oh, we want to syndicate multifamily. Okay, we want to syndicate multifamily in the Southeast, or even more specifically than that, we want to syndicate multifamily in Nashville, Tennessee. All right, just for instance. And we want to look for value add deals between 1985 and 1995. And then you want to go even further than that. We want to target deal sizes, within a certain range. So, let's say you're starting out, you want to do $5 and $10 million deals. And that's going to be based on, that's a topic you have to discuss with your business partners, because you have to determine what you're able to handle from a loan guarantor perspective. From a liquidity standpoint and net worth standpoint, and hopefully with your business partners that you have assembled together, you'll be able to provide those. But you need to have that conversation, make sure everybody understands they're on the same page. And then once you do that, then you can start working to build first your systems. In the bullet points, it says goals, teams, and then systems, but I would say it's goals, systems, and then teams. Because at first you're putting in all the work, you're doing all the work. It's a lot, it's time consuming, it's everything, but that's the way it works. And every time we start a new line of business, that's the way it goes again. I jump back in and I'm touring, I'm running around, I'm doing all this work until we get the systems down. And then we start adding team members to the system. And that's important to do it that way, because you need to understand the system. And instead of hiring a team and letting just the team come up with the system, and we'll talk about that in a minute. But if you build the system, and what I mean by that is, this is how the pipeline works. This is how we communicate. This is how we submit to deals. This is our LOI template. This is, our criteria for terms on earnest money deposits or due diligence and those types of things, and get all that system down in place. And then you can start adding teammates, handing that process and that system off to the teammates, and then let them at that point in time customize the system to them specifically, because that's how it grows. Because you certainly don't want the system to stay the same as it was when you put it in place, when it was just you. Because as you grow and you grow rapidly, you're going to want to add more and more team members. And the way to do that is to look for, I try to break things down into modules, kind of. So you have broker relations and you have investor relations, and you have all these different pieces, and you say, okay, what can I find somebody to do this piece of what I need to do? And then this goes back to looking at the strengths and weaknesses. And now we're doing it together as partners. We're talking about our strengths and weaknesses, and we're saying, okay, we have a weakness here. Maybe we have an accounting weakness, and it's just taking away from what we really need to be doing. It's holding us back in scale. Do we need to add somebody to be over the business department or an accountant to handle that for us? And again, you got to look at what you're good at, what your team is good at, and where your weaknesses are, and then add people to kind of hedge off that weakness. So whether that's HR or whether that's broker relations, acquisitions, underwriters, whether that's attorneys or insurance brokers, whatever the case may be, look for whatever it is that you feel is bogging you down and you're getting tied up in the minutia of that process. Try to find a team member that can take that off your plate. And that allows you as the partner to see the big picture. And then as you see the big picture, you're really, as the partner, supposed to get to the point where you're just moving chess pieces. You're putting people in the right seat. If anybody's read the EOS system or Traction, the book Traction talks a lot about that. And also Jocko Willink talks about the decentralized command. In other words, if you have a platoon leader or a leader in the military, I don't know as much about military lingo, but if you have that leader and they are focused on firing on the enemy just like everybody else, then they are not focused on the strategy of overcoming the enemy or where the enemy is coming from, because they're focused on the actual battle and not the big picture. And that's what we have to be careful of. You have to be looking at the big picture. And so the more you can offload to your team and delegate tasks to your team and not micromanage, let them take ownership of that, the more you can see the big picture. The reason you want your team to take ownership is because if you are micromanaging, then your team is going to become detached, because they know you're going to come in and you're going to change everything to be exactly the way you want it. And so all the work they just did is a waste. And they're just like, well, what's the point? They're just going to come in and change it anyways. And so they become detached. If you allow ownership to take place, and I'm big on this about going to my team and say, this is what I want to do. I'll let you pick out the system or the software that you think is best. I want you to research it. I want you to give me 3 options and why, and the recommendation that you've come up with and why you're recommending that. And so that's complete ownership. So now they have buy-in to the success of that software or that implementation, whatever it may be, because it's their idea, and they now have personal interest in it succeeding, instead of you telling your team members what you want them to use. Now, there's cases where that's going to occur, but it's always important to allow your team to have ownership of a process, and you're still supervising. You're not completely detached. If you've read the book, Dichotomies of Leadership, it comes after extreme ownership. It talks about the balance of that. You want to be decentralized in your command, but if you get too detached, then your team is running rogue, and then they become clingy to their process and are unwilling to let you change it because you've been detached for so long. So you got to be careful about that balance. All right, I want to go ahead and take another break and see if we have any comments. No, just talking about the book Traction. Nothing so far. Guys, please go ahead and jump into the Q&A and ask me any questions you want. I'll go ahead and talk about kind of the way our system is set up. And we have departments, and as I mentioned, Dan is over investor relations, and he's over marketing. I'm over acquisitions and development, and then Danny is over asset management and capital markets. Each department has directors. So there's a director of marketing. There's a director of investor relations under Dan. Okay, so you can see the org chart starting to develop. Under myself, I have currently right now a director of acquisitions. And then underneath of him, Eric, you have different directors because I have different asset classes, or not directors, associates. So I have acquisition associate over multifamily and an underwriter over multifamily. I have an acquisitions associate over car wash and an underwriter for car wash. I have an acquisitions associate and underwriter for hotel and also for self-storage. And that's the way that we build it. And then under Danny, he has a director of finance and a director of capital markets, and then they have their team under them. You want to remember that nobody can really manage more than 5 people if that's their only focus. So if you have a director and then they have no more than 5 people under them under each sub department, that's the way you want to keep it. And then each of those 5 people could manage 5 people. And that's the only way that really your directors are able to manage. So you don't ever want to have any more than 5 associates under a director. If you have that, then you need to split and go with another director, assistant director, or something like that, and divide it so that nobody's ever over more than 5 people directly. It's just the way it works. You get too distracted. I feel that's a good process there. And that's basically the way we work. And again, I showed you the link to the passiveinvesting.com team. Take a look at who we have there. Our team is amazing. It really is. One of the things that we do when hiring is allow our directors to choose that person. And we allow them at first, obviously we are doing the hiring because we want to hire great people. At the ground up, there's no director positions. It was just all associates and just people, just employees. But we like to build the pyramid from the bottom. And it sounds a little weird, but we start with the tip, right? So you have 1, all right. And then that person adds 2 people under them. All right. And then that pushes them up. And then those 2 people add 2 people under them. And so you're building this pyramid, but the person at the origin or the apex, if you will, just keeps moving up as you add people under. And that's how we build that way. You don't want to build too horizontally. You want to make sure you're building up. And then as you're building up, you see you started with an apex with a point. And then as you build and you do that underneath, it builds that natural base, that very stable wide base. And it gives you the ability to control it from a singular point, and it allows the base to get really wide. That's the only way that you can scale. So let me know if you have any questions on that analogy. All right, go ahead. We had some questions about why we can't see other people's comments in the chat. We usually keep it that way. Just, you never know what might get thrown out there. So we like to keep control of it. I hope you understand that. But I can see all your comments. So rest assured, I'm looking at them right now. Any recommendations for resolving conflicts and risk appetite? Or resolving conflicts is to address them head on. I always remember this saying way back from when I was a contractor, a general contractor. When I went to the building convention, and I went to this one seminar, and the speaker said, pain is inevitable, but agony is avoidable. And that was in relation to conflict. So nobody wants to have hard decisions because it's painful. But if you let it go, it'll fester and it'll become agonizing. So deal with it while it's a small wound and not when it's infected and you have to amputate. So that's key to dealing with conflict. Have the conversation. We believe in very transparent communication, very professional, but direct. You have to communicate. If there's a problem and you made a mistake, say, I made a mistake. That's the problem, but this is where we're at. How do we solve it? And own up to it. If somebody's doing it, just say, hey, you can be direct and still not be a jerk about it. That's difficult sometimes, but that's the best way to handle it. A Bible verse that comes to my mind, a soft answer turns away wrath, but a harsh response stirs up strife. And that is true. We all know it. And so be sure to, but handle it immediately. It doesn't mean you don't address it. It just means you address it in a way that is professional. What happens if you're partnered with the wrong person for whatever reason? How do you get them out? It's very important to have operating agreements in advance. You never want to partner just on word, because everything is hunky-dory at the beginning and everybody's friends at the beginning with every partnership that's ever occurred. No one ever, I'm sure there's some instance, but most people don't get in a partnership with someone they don't like, okay? Or somebody they know is untrustworthy. Everything is fine at the beginning. And then something goes wrong, or appetite shifts, or interests vary. And so you want to have those things delineated ahead of time. If you don't have that, and there is conflict brewing, you want to go ahead and have that conversation. Just say, hey, you know what? I think it might be a good idea if we just go ahead and delineate. If anything ever happened, or this, we came to a disagreement, you need to understand what the points of separation would be and how that works. And just keep it nice and clean and transparent and on paper. It's a good way to do it. But it is, again, not just a business transaction. It is personal. It does happen where business partners, go south. I'm very fortunate to have the business partners I do. I consider them friends. Their family is our friends, and we just have a great thing going. I'm very blessed, but I know that that's not been the case with everybody. So pick your partners carefully, do it through, spend time together and get to know each other on a personal level, even past business, like what are their goals, their interests, what's their life philosophy, even down to religion and different things like that. It does have an effect on that. If you're, if you have a conflict at a very base moral level, you're going to have a conflict at business. So you can't overcome some of those things. So pay attention to that, and just think, oh, this person has what I need, so I'll overlook some of the things that I know might be a problem just for the sake of my own benefit, because I want to get this business off the ground, and it'll be disastrous in the end. One thing that I want to point out, kind of keys to success. You want to remember that you can only work so many hours in a day. Whenever you start a business, you want to always be looking towards the exit, not just building a business so that you can work in it. That's just another job. You want to build passive income from your business, not just from your investments. And so the way to do that is to make money work for you. Money can work 24/7. It can work while you're sleeping. It can work while you're sick. It can work while you're on vacation. It can work while you're at your children's recital or basketball game or soccer game or whatever the case may be. And so you can enjoy those things, because life is about relationships, not about money. So make money work for you, and don't be a slave to your money and the clock. A way to get to that point is you have to utilize people. You have to utilize a team. People get caught up in the, I have to do everything because I'm the only one that can do it as good as I can do it. And yeah, in your opinion, you are correct, because you have a big ego. And I'm speaking generally to whoever it may apply to, myself included. Ego is an enemy and is the biggest stifler of growth that will occur in business. And the reason for that is it's like, well, I can do it. I don't need help with that. Well, then just candidly, then you're dumb for thinking that, because you don't know everything. And there's somebody out there better than what you are best at. I can guarantee you that. And until you understand that, you will never grow. And once you understand that, then, and you don't care about you getting the glory, but about growth, that's the biggest thing, then you'll grow. And your team will be able to flourish because you're able to give them credit, because you're not worried about always, patting yourself on the back. So be careful about ego. Like I said, it's a big problem. Humility is key. And don't micromanage, as I mentioned before. So make money work for you, have a great team that can work for you. Don't have an ego, stay humble, and don't micromanage. Those are kind of my key takeaways. Let me scroll through the chat. I have a few in here. All right, let's see. Just give me a second. I'm reading a couple of these. Off topic question about the interest rate and how it's affecting deals. It's off topic, but let's talk about it. It's fine. It's in the questions. It's markets are cyclical and things change. The only certain thing is that it will change. And so You just have to adjust to it. The sky is not falling. The world is not ending. People have made money since the beginning of time, and they'll continue to do so until the end of time. And so don't get caught up into, this mentality of, the sky is falling. You can always make money. Just change the way you do things to adjust to the environment. You have to learn to exist in the environment in which you live. And so if interest rates go up, then you adjust your underwriting and you buy deals that make sense, and you don't, and pricing adjusts according to the interest rates, because it does not pencil to anybody if interest rates are higher than what they were 6 months ago. So if you were getting interest rates of 3 and now they're 6, that deal cannot sell for as much. Just doesn't work that way. Even with the inflation and the rent growth that we've seen organically through inflation, you just can't do so. And so it takes a little bit of time for sellers to realize that they can't make as much money as they were when interest rates were low and prices were soaring. And so prices have adjusted and come back down, which is good, which means the IRR and the cash on cash go up. And so it's all cyclical, and it's all going to be okay. And so you just need to be ahead of the curve, make quick adjustments to the changing environment, and be confident in your team that that you have all looked at the details and understand what's going on. Hope that answered that question. Question: how do we fund our first few deals? Cash funds is the biggest issue for me jumping in. We syndicated our first deals, right from the get-go. I think we raised just at $1 million for our first deal. It's 8.9 million was the acquisition fee. So maybe it was closer to 2 million. I apologize about that. This is what we raised. And man, we were sweating bullets, and I think, we're doing $40 million raises now. If it wasn't for any market shifts, I think we could have scaled much higher than that by this point. But again, you have to grow as much as the market will allow you to, and not faster than that, so that you don't become unstable. But that's how we funded our first few. We didn't use a KP. The 3 managing partners were the KPs at the beginning, or the loan guarantors. Also curious if team only focused on accredited investors, or were you once open to 506B at some point and involved? We were at the beginning open to whoever, because we were unsure about how much we could raise. So we did allow 506B. But then, just for obvious reasons, your average accredited investor is putting in 100,000 or more, whereas that's not the case, obviously, with your 506B investors. And so for the idea of limiting the number of investors in a deal and maximizing the amount that each investor invested, that is why we made that decision. And so we don't typically, but we are working on, but we also don't want to forget about the 506B investors. Well, another reason for doing that is also we can openly market, which is a big deal. So we made that change for that reason also. But we are working on a Regulation A fund, because we want to, we have friends and family, people who go to our church, people in ministry, missionaries and pastors that want to invest with us and are not accredited investors. So we're trying to come up with that solution for them, and that we see as a Regulation A, kind of like a crowdfunding platform that will invest as a tick alongside. So we, that's what we're working on now, but it's pretty detailed. Question about the recording. The recordings will come out if you're registered for the webinar. So once they render those, you will get that. So no worries on coming in late. Be able to catch that. You'll just miss the beginning part. So a question about exit was raised about how do you exit. I think right now our focus is on exit of specific asset classes, but if passiveinvesting.com, which is it is an LLC that it's passive really. Each entity has its own, or each property has its own entity structure under it, and so I think there could be an exit for passiveinvesting.com if a big REIT wanted to come in and take the whole portfolio. We haven't really looked that route yet. We're more looking at exit on, like for instance, car wash. If we were to exit car wash, we would do it either. There's 3 exit possibilities. There's either a lease back of the ground, so we could sell the car wash and keep the land and lease the car wash on the land. That's not what we plan to do. We could roll the whole thing up and sell to a REIT at a good multiple and sell everything all together after we get to 150 plus locations, or we could IPO and have like 40x multiple on that. And that's the plan for that one, is to IPO that, get the valuation up high enough to be able to IPO. So that's what we look at in different asset classes. But on an individual level, on multifamily, what we look for is who is the buyer going to be when we sell this property. You have to keep that in mind, because the bigger the property, the bigger the buyer pool, or the more institutional buyers you're going to have. And they are the easiest to transact with because they're used to it. It's just business. Some of the mom and pop operators are, a very big transaction for them. They're not used to throwing around big numbers. So they're very skeptical and suspicious, and it tends to be that way. And so it can be a little bit harder. So we always try to buy multifamily properties that we can sell to institutional groups, because they have a fund, they need to place capital, and they are driven by putting money to work. And so they have to buy deals. And so that's who we're looking for on the exit. Great question so far. Question about what to be cautious for in your first multifamily deal. There's so much I can say. You just have to be sure of that you've done your research, on the market, on the rent comps. Always be conservative. People try to push the limits too much, and underwriting refis and all the rest. You don't, like, for instance, rates changed significantly in the last few months, just a quarter. And if I was underwriting a refi, at the rate that I bought the property at, I'm kind of screwed. Or if I didn't buy a cap because I thought the rates would stay down, I'm also kind of screwed. So, you have to really pay attention to what's going on. Don't oversell yourself, undercommit, over deliver, and make sure that you're checking what you think is correct with other people. And multifamily specifically, talk to your property management company or asset manager or your team, and make sure, hey, this is what I'm finding as rent comps. What do you think? Do you think this is achievable? They say, well, not in that location, because, you never know what they're going to say, but you need to make sure you get feedback from your team and make sure that everybody's in agreement with that. That's the biggest thing to be careful of, is to not be overconfident in what you know. All right, let me keep going. Any recommendations when approaching family and friends for multifamily investing? I will be the general partner on my first deal, but would love your input. It's, that's a tough one, because your family knows you. All right. I was not always the most responsible kid growing up. And so my aunts and uncles and different things like that, that sometimes it takes a little while for them to get over that remembrance of you. And so what I find to be helpful is, just let it come up naturally in conversation, and don't be salesman-y about it. Never be that way with your investors. Don't act like you have to have their money. Act like, again, you've seen the thing about sell me this pen, and it's like, hey, sign this right here. Oh, you don't have a pen? Well, I have a pen right here and I'll sell it to you. It has to be, you have to let them realize that this is actually something that they want and they need. And it's not a sales trick. It actually is. We all understand that real estate is the best investment vehicle that you can get with depreciation and all the rest. So the tax benefits are unparalleled. And so you just really need to just, like you would anything else. If you find like a life hack, right? Everybody's sharing these life hacks on social media. Well, this is an investment hack, if you will. It's not a hack, it's tried and true, but you need to share this great thing that you found out. Not like, hey, we want to buy something and I need your money. It's like, oh man, I found this great investment opportunity. It's amazing. I got a bunch of people investing in it, and just talk about it, and maybe not even have a call to action and the initial conversation, and slow roll that. That's how I would do it, because, you're going to be family after that deal's done. And that's also a good way to make sure your underwriting is correct, because you don't want to have a deal go bad with family members. But your investors are your family. So, all of your investors should be considered that way. You want to take it very, very seriously. To what degree, if any, do you utilize overseas VAs to help you scale with more reasonable expenses to do a lot of more tedious tasks? We use VAs on a one-off basis, maybe, you know, if you're planning an event or different things like that, but on a day-to-day, there's too much IP that we don't really want going out, and personal information of investors. So it's hard to use VAs at that level. You know, if you want to do like a presentation or things like that, I'm sure you can use a VA. We have just the best marketing team ever. So they handle all of that, the presentations and the advertising, all the rest. So we don't have to utilize VAs. And if you can do that, I recommend that. A question, why are we exiting the car wash business? We are not exiting it yet, but we only get into businesses that we plan to exit, because the exit is where the big pop occurs for investors and for us as general partners. So again, we always want to enter a business with the idea of exiting, unless you just want to work till you drop dead, which is not really my goal. So I want to exit and enjoy my family. I'll be real candid with you. I love business and I love what we do, but I love my family more. They take first priority, and if I have a choice between the one or the other, I will definitely choose family over the other, even if that means less money. And you really need to have that mindset, or else you're missing out on life. Money is empty. It definitely makes things nice, but if you're all alone and have tons of money, your life sucks. So I'm just going to be real direct and candid about that. All right, that's all the time that we have. I do want to go ahead and see. I don't think we have all the bullet points up, but I wanted to go. Oh yeah, we do. Great. I'm going to go ahead and share my screen and talk about next week's webinar. We're going to have Ed Gilmer is going to be speaking with you next week. He is director of our capital markets. So he talks to all the banks and lenders and different things like that, all the fun and boring stuff that I don't like to do. He gets to do it along with Danny Randazzo, the other managing partner. So, but he's got a lot of stuff for you. So he's going to talk about the purpose of a lender term sheet, what makes a good lender term sheet, and so much more. That's next week, October 4th, at same bat time, same bat channel. And be sure to check that out next week. I will go ahead and switch off the screen share, but thank you so much for everybody joining us today. It was a great session. I always love getting on these and talking, and I love the questions. Great back and forth. If you have any other questions, I want to reach out directly. We're very available. My email is brandon@passiveinvesting.com. Feel free to reach out and ask me any questions. I'll do my best to respond. I try to be very responsive no matter what. But sometimes I do get tied up. I'm going out of town actually tonight. Kids are off of school for teachers conference, and so we're going to Dollywood with the kids for a couple of days. So I'll be out of pocket for the next 2 days. But if you have any questions, reach out and I'll get back with you as soon as possible. But thanks again for joining us at Multifamily Investor Nation webinar, and we'll see you next time.